let's begin with a pain trade of 2017. At least that's what it was as far as I'm concerned, Jordan. Was it that for you as well?
Well, John, actually it wasn't. But if I look at where I was last year, we were sat here thinking maybe the dollar would continue its outsized gains. We had this bit of a disconnect between the strategy view and the economics view. So the economics view was that Donald Trump's policies actually might struggle to get through this year, but also would have a very low impact on growth and therefore on treasuries and where rates would go. Well, the strategy view was maybe that's the case, but the market's going to price for more than that. And what we saw is over Christmas, we had to think about it, sat down in January, and we said, actually, what does Donald Trump plan to do in his first 100 days? And whilst he had these tax reform plans, he also had some big negative plans when it comes to trade and NAFTA. So we thought, actually, this is probably more of a scenario when the dollar doesn't do so well, and actually expanding the fiscal deficit is that double deficit problem should drag on the dollar. So we got the view right. We were short dollars pretty much from the first week of January of this year. Going into next year, we're still perma-dollar bears. We have to be more concise about where we target that. So in dollar yen, it's a bit of a mixed picture. You've got the carry environment we've got going on. But in euro dollar, I think it's a much easier trade, and in cable as well with the UK. You've got ECB potentially tightening policy. Yeah. You've got the Bank of England, of course, on a hiking path. So I think it's more dollar weakness because, as you said, we've had that dollar weakness this year, the most dollar weakness in a decade. But it's not actually yet to levels where you can say it's at a bottom. So it continues, John.
But, Jordan, has that become a consensus position now, a crowded trade, so to speak, that the dollar's not going to catch a bid? I can't see why it's going to catch a bid. I keep hearing that more and more. And that's the radical difference as we go into 2018 compared to 2017. Everyone was on the one side of the boat last year. They now are, at least as far as I'm concerned, on the other side of the boat. Do you see that as well?
Yeah, John, I do hate being on the consensus trade. So, you know, when we come up with these calls, when we went short dollars, people said we were crazy. We had to have about a month or two of meetings to start to get people to really buy into that view, just because the price action was going in our way. Now, for this year, most people are agreeing with that view, but it's a little bit more sanguine. So we have to be a little bit more specific with those views. So in dollar yen, for example, it's a little bit trickier. In euro dollar and others, it's a lot clearer. I think it's hard to be bearish on the growth currencies, essentially, in terms of what's going on. We are going to have that Goldilocks. And that's why everyone's kind of agreeing, because the data's telling you that. The only way you get out of it is you have to remember the dollar smile. There's three scenarios. The dollar does well when everything's selling off in a risk-off environment. The dollar does really well when the US is growing way above its potential. Now, we have that risk next year that it does grow above potential. Therefore, we get more Fed hikes. But you have to remember the most powerful moment in monetary policy to FX is liftoff, which is what you're going to see towards the end of next year from the ECB and maybe even the Bank of Japan. A tail risk, but maybe.